What's going on, guys? It's Jimmy here. So the Fed just released their minutes, their notes from their most recent meeting. And take a look at what is happening here. First of all, because the Fed has raised interest rates 11 times now in a little bit over a year, mortgage rates have soared to their highest level in 21 years. 21 years. Wow, an ouch for a lot of people. And I'll let you hear a video here in a moment on what this is doing to the real estate market and the housing market. But US mortgage rates surged this week here yet again, rising to their highest level in 21 years. The 30-year fixed mortgage rate is now over 7% on average, averaging 7.09% in the week ending August 17th. Wow. It's like, how much higher can it go? Up from 6.96% the week before, according to data from Freddie Mac released on Thursday. A year ago, the 30-year fixed rate was 5.13. We're now about 2% higher in a year. And that's a lot of money. And remember that this affects rates on everything, not just home loans. This is car loans, this is personal loans, this is credit card interest rates. Credit card interest rates are just absolutely just abysmal right now, the highest they have ever been in the history of credit card rates. Take a look here. Okay, you can see here right from Forbes, what is the average credit card interest rate this week? This is absolutely mind-blowing how high this is starting to get. And remember here that credit card interest rates can go up pretty much every month, okay? Because they're variable interest rates, they're not fixed. They just go up, and it says it in your terms and conditions. They can raise it pretty much at any given time. The average credit card interest rate is now just under 25%. That's 24.72% per year. Per year. This is the average. This means some people are paying less, some people are paying more. According to Forbes Advisors weekly credit card rates report. Oh my gosh, this is like loan sharking. Wow. The Federal Reserve keeps tabs on the average interest rate that U.S. consumers pay for a variety of different financial products, credit cards included. In May 2023, the average credit card interest rate in the U.S. on accounts with balances that assessed interest was 22.16, according to the Federal Reserve. That was back in May. Okay, now it's gone from 22% to almost 25% just in a few months. This gives you an idea on how quickly they're rising because the Fed keeps raising interest rates. Of course, the annual percentage rate, APR, which means you pay that interest rate every year. Wow. Wow. And of course, what you pay might not match up with the average. Okay. Again, it's based on what you are actually paying, but this is the average. Wow. Now, what that means, just in general, just for round basic math, is that if you have a $10,000 credit card bill or a credit card balance, and if you have a 25% interest rate, you're paying $2,500 in interest every single year. Every year, $2,500, $2,500, $2,500, $2,500, and you still have principal that you owe them. Okay, you still have the balance that you owe them. So that means essentially in 4 years, only 4 years, you're paying them $10,000 in interest, and you still have the $10,000 in balance that you owe them. This is why credit cards are just the absolute worst type of money you can owe. It's the worst type of debt you can have. It's terrible. And this is why you don't want to go and charge your food your groceries or your gas or anything on a credit card unless you absolutely need to. The only type of really good credit card debt is if you're going and putting stuff on a credit card and you're paying it off on a monthly basis. Because if you pay it off every month completely, it will build your credit and then you won't pay any interest if you just pay it off in full every month. In fact, then you'll actually get rewards from your credit card company as long as you have some type of rewards system from it. You'll either get cash back or you'll get airline miles or whatever it is. Cash back, of course, is the best because then you can literally just apply it to your next statement and they're paying you instead of you paying them, even if it's only 1%, 1 or 2% or 3% or 5%, for some type of categories, whether it's groceries or anything like that. But remember, if you're paying 25%, that's 25% of the balance for in general terms that you're paying, and that's means every 4 years you're paying 100% of the balance, and you're just giving them your money. That's how the term "the rich stay rich" or "the rich get richer" and "the poor get poorer." It's basic concepts like this. So, um, yeah. So if nobody's ever told you this before, this is just if you work at the same job with somebody else, if you're a teacher and there's 50 other teachers there, if 25 of them are not charging a credit card and 25 of them are, those 25 people that are charging balances on their credit cards are going to stay poor their whole lives, and 25 that are not doing this are going to be considerably richer throughout the next 30 years than the people that who are charging stuff on their credit cards and paying 25% interest over the next 10, 20, 30 years. Okay, so this is just the system beating you down, and really you can't even blame whoever you want to blame. It's just you having financial knowledge to know this stuff. Okay, because it's just you can't really, I mean, blame it on whoever you want, but it's just you. Because the reality of it is that if you go buy $200 worth of groceries, if you pay for it with cash or if you pay for it with your debit card, as opposed to paying for it with your credit card and not paying it off right away, that $200 worth of groceries, if you pay the minimum balance over 4 years, that $200 worth of groceries is actually going to cost you $400 worth of groceries, because it's, again, you're going to pay double the amount in 4 years because you're going to pay 25% interest over the course of 4 years, or 25% per year. In 4 years, it's going to cost you twice as much. So remember, these credit cards are absolutely the worst thing ever. It's basically loan sharking. It's basically going to a loan shark, that guy in the Italian mafia or something like that, who's going to say, "Hey, yo, it's going to cost you a lot of money." I know my accent's terrible, but and the guy who will break your knuckles or break your legs if you don't pay him back. That's basically what credit cards have become. 25% interest on average. That means if some people are paying more than that, some people are paying less. But even if you're a little bit less than that, if you're 20% interest or 18% interest, don't get all excited because it's not that much better. Now, if you have a mortgage or a car loan, it's going to be considerably less because it's a secured a debt. They have something that they could take from you if you default on it. They're going to take your home, they're going to take your car, and it's going to be much, much less. But even so, mortgages now are at 7% interest. That's more than double than what they were just a year or two ago. I mean, mortgages were at the 3% or even less. And car loans, I don't even know what they were at, a year or two ago, but they were considerably less, maybe half or something. So you got to remember here that, and again, they're trying to do this to lower inflation, but it's honestly crushing the average and middle class, lower class Americans right now. And honestly, we're not the only country doing this. If you've been watching my channel, this is happening all across the world. In fact, Russia just raised their interest rates by 350 basis points. To give you an idea here, the United States has been raising interest rates by 25 basis points. That's 1/4 of a percent. Okay, 1% would be 100 basis points. Russia just raised their interest rates because they're getting absolutely just crushed by interest over there, or inflation, I should say. They just raised their interest rates by 350 basis points, 3.5% in one shot. in one shot. So yeah, it's just like inflation is just absolutely going crazy everywhere right now. And yeah. And here's the thing, the Fed just released their minutes today indicating the Fed may not even be done with rate hikes. Another interest rate hike is still on the table, according to the Fed, the Federal Reserve's officials. Newly released minutes from the Federal Open Market Committee's latest meeting, which they just reserved or they just released the basically their notes here today, even though it was a few weeks ago, show that while some officials were prepared to continue June's interest rate hike pause, members continue to view inflation as a threat and are willing to hike rates further to address it. Yeah, most participants continue to see significant upside risks to inflation, which could require further tightening of monetary policy, aka raising interest rates here yet again. The Fed in July raised its short-term benchmark funds another 0.25% to target range of 5.25 to 5.5%. Just to give you an idea here, when Russia just raised their interest rate here just a few days ago, they raised it 3.5% in one shot to 12% after the ruble plunged to 1 penny to a US dollar. So their dollar basically is worth 1 penny compared to our dollar, the ruble. And they raised it 3.5% in one shot. We're at 5.5% total. They raised it 3.5% in one raise. Yeah, so just so you guys know what's going on here across the world, we're not the only one dealing with inflation. Inflation is a lot higher in a lot of places. Of course, that doesn't make it any better for us, but you can see here. Here's actually from the Financial Times Global Inflation Tracker. See how your country compares on rising prices, aka inflation. So here is a graph on inflation in the world, and the blue line here is the U.S. versus some other notable countries, United Kingdom, the Eurozone, which is basically a blend of European countries, and Japan and the United States. So that's just a quick graph to give you an idea here. The United States is in blue. So you can see the large spike there. But take a look at what the United Kingdom was, one of our closest allies and comparables there, how much higher inflation was compared to the United States. So, yeah, pretty high. But I think one of the largest problems right now is the interest rates are going to be absolutely a killer right now. Credit cards, auto loans, home loans, and it's just never ending. So I'll keep you up to date here. Let me know your thoughts here in the comments. If you haven't yet, click the subscribe button down below and the bell icon so you don't miss out on any new videos that come out here every day at 10 a.m., 3 p.m., and 8 p.m. Eastern Standard Time. Thanks for liking and sharing these videos. Click here to see this massive announcement that will affect Americans' wallets, or click here to see why people are boycotting Walmart. So click on one of those videos next. Thanks for watching, guys, and I'll see you in the next video.